Foods Incorporated is one of the world's largest food companies and a recognized leader in protein. Founded in 1935 by John Tyson and grown under three generations of family leadership, the company has a broad portfolio of products and brands like Tyson, Jimmy Dean, Hillshire Farm, Ballpark, Wright, Adels, IBP, and State Fair, all big brands and recognized in its own sectors. Tyson Foods innovates continually to make protein more sustainable, tailor food for everywhere it's available, and raise the world's expectations for how much good food can do. It's headquartered currently in Springdale, Arkansas, and by the end of 2017, the company had 122,000 team members. Right now, it sits at the second spot for the greatest food company in the world in revenue and is the biggest protein provider in the United States. The years 2013 to 2017, the most interesting and remarkable one for Tyson Foods was certainly 2017. During that year, the company managed to value its stocks over 30%, leading to a series of articles by the end of that year questioning the reasons for such growth, as the industry had seen a positive yet very smaller average of 22% growth that year, and also raising the question, would they be able to sustain such growth? To summarize the market's view of Tyson's strategy on that year, I will quote Fitch Ratings, one of the big three credit rating agencies, on Tyson's acquisition of Keystone Foods. Quote, it is complementary to the existing portfolio, improves scale, and is consistent with the company's strategy of transitioning from a commodity meat and poultry processor to a higher margin protein packed foods firm that should benefit from the expanded growth opportunities via new international platform. End quote. Well, due to the high amount of debt accumulated by the company and the unhealthy liquidity ratios that we will further explore, even if the rating companies believe that's a very good trade and acquisition to be had, and that looms around the $3 billion margin. The company's rating has been on the verge of losing its investment grade and currently sits at a triple B or Baa2 grade, considered to be medium low and close to non-investment or junk grades. To complete our analysis, we will be looking at four comparators of Tyson Foods. The first one being Hormel Foods Corporation, which is an American food company founded in 1891 in Austin, Minnesota, originally focused on the packaging and selling of ham, sausage, and other pork, chick, beef, and lamb products, most famously Spam. By 1980s, Hormel began offering a wider range of packaged and refrigerated food brands. There is Bridgeford Foods Corporation, which traced its roots back to 1932 and pioneered the manufacture and sale of frozen bread dough to supermarkets and institutional customers, beginning in 1962. There is Sanderson Farms, which is a Fortune 1000 company engaged in the production of processing, marketing, and distribution of fresh and frozen chicken and other prepared food items. They are traded in the Nasdaq Stock Exchange, differently from the other companies we will be looking into, which are traded in New York Stock Exchange. And also, Sanderson Farms is the third largest poultry producer in the United States and produces 9 billion chickens per week. But not least, we will be looking into Pilgrim's Pride, which is a multinational corporation based in Brazil. They have the capacity to process about 36 million birds per week, and their products are primarily distributed through food services and retail outlets. Pilgrim's Pride is the known supplier of Kentucky Fried Chicken and was named the Supplier of the Year in 1997. They also have other big customers like Walmart, Publix, and Wendy's. In a broad sense, meat, poultry, and seafood market was valued in 2016 as a 4.2 trillion market in the United States. The growing population results in increased consumer goods demand, which is anticipated to ultimately contribute towards enhancing the supply of meat, poultry, and seafood. This directly reflects on the positivity towards Tyson and its competitors regarding the market. We are to praise Tyson for its incredible 2017 gains. We must also highlight the performance of its potentially most dangerous competitor in the poultry market, Pilgrim Pride. During that year, their share values increased from 19 US dollars per share in December 30, 2016 to a peak of $37.28 per share in December 1st, 2017, meaning almost doubling in size during that 1 year. Quoting Bill Lovat, Chief Executive Officer of Pilgrims in their 2017 fourth quarter report, open quote, we generated strong, well-balanced, consolidated performance in 2017. Our US and Mexico operations were solid despite logistical challenges in fourth quarter due to the after effects from natural events in Puerto Rico, Mexico, and the US. While our other operations were consistent, the performance once again demonstrated the strength and diversity of our portfolio of bird sizes, and is what fundamentally differentiates us from the competition, giving us the potential to reduce volatility and generate higher margins over time. Financial point of view, the analysis of Tyson's financial statements for the years 2013 through 2017 reveal how Tyson had long employed very high leverage ratios and sustained worryingly low liquidity ratios that were only accentuated during 2016 and 2017, during the investment waves that supported the company's growth in that period. Those waves were mainly sustained through the issuance of long-term debt and paired with a maintenance of high levels of short-term liabilities, e.g., Tyson's long-term debt increased almost 50% just in 2017, reaching $9.3 billion, and overall liabilities increased 37% in that year. While Tyson Foods was no stranger to high debt ratios and low liquidity, as we could see during the whole period, quick ratios were never above 0.78, and net debt was as high as 4 times as their EBIT. However, 2017 saw an overall increase in gross debt of 67%, the biggest we have by far that we've seen in the whole period. Pilgrim's Pride growth was also fueled by rampant increase in liabilities, as they more than doubled their total liabilities during 2017, and for the first time in that period saw their quick ratio plummeting to below 1 values. First look at the vertical analysis of Tyson's balance sheet and its comparison to its competitors reveals that it weirdly has the lowest inventories to total asset ratio in all industry, which makes little sense when considering their strategy regarding short-term liabilities and low quick ratios. However, we believe it is due to the very discrepant amount of goodwill the company displays in its statement as a consequence of its large merger and acquisition strategies. Non-intangible and goodwill sum up for 55% of the company's total assets. On a side note, one must notice that Tyson's inventories are listed at $3.2 billion value in 2017, a great deal more than the sum of its four main competitors at $2.8 billion. Even if Tyson's revenues are by far the biggest in the US market, its profitability indexes are far from being the best. The company had the worst return on assets on the years 2014 and 2017 and was below the market median for all the periods studied. The same holds true for its net margin and earnings before interest and taxes margin. This may have to do with their obscenely high assets values pumped up by their large goodwill weight. On the other hand, the company's return on equity was below market median for 2014, 15, and 16, however, above it for 2017, emphasizing the company's success in that year. While Tyson's profitability indexes are mostly below market median, its liquidity ratios seldom are not the worst amongst the observed companies. Quick ratios kept steadily around 0.75, and current ratios ranged from 1.52 to 1.77, while their competitors' medians range from 2.39 to 2.95. This impacts the company's investment rating without a doubt, and raises the questions of whether the company would be able to cope with any kind of struggle in their sales. As expected from our previous statements, Tyson's had abnormally high leverage ratios when compared to their competitors, some faring up to 45 times their competitors' medians. This evidences their preference of source of funding quite clearly. And finally, regarding their turnover ratios, Tyson managed to maintain turnover ratios steadily lower on all fronts against their competitors, being below median and average of their biggest competitors by a noticeable margin during all the analyzed period. This is probably how the company sustains its low quick ratio positioning and also adapts to market price fluctuations. In conclusion, Tyson's position as the largest protein provider for the US market is unlikely to be challenged at any time soon. The strength of its merger and acquisitions, paired with their diverse and solid portfolio, have time and again proven to be strategically powerful and sufficient to guide the company through tough times. Sadly, the recent trade wars initiated by President Donald Trump's attack to trade deals have taken a heavy toll at the company's sales due to the imposition of high tariffs and taxes. And the growth seen in 2017 was only enough to fuel Tyson's maintenance in 2018, which has been a bad year for Tyson overall. The recent acquisition of Keystone Foods for $3 billion gave the investors some hope, and this has reflected positively on stock prices. However, most analysts do not recommend buying or selling Tyson stocks at the moment, and so do we. Their liquidity problem and leverage and high leverage ratios seem to be just not the positions in the right position right now, and the future of the trade wars is still uncertain, leading to more uncertainty on the future of Tyson Foods. It is, however, unlikely that it will lose its spot at the top of the food processing and protein selling at the US market.